Hello everyone. I hope all of you are doing well and geared up for the upcoming September 25 examination. Okay. Welcome to this session where we will be covering lots and lots of questions, very important questions from almost all the Ind AS, and you will have a good grip on how to approach them in the examination. I hope my audio video is good. If at all you feel that the audio is lower or the screen is not clear, you can let me know. Before I begin, a couple of quick things. One is this summary of Ind AS important pointers. Okay, this you can download it from our resources section on our app. Here what I've done is very briefly for each standard. For example, Ind AS 2 in about 1 page, Ind AS 16 in about 1.5 page, Ind AS 38 in about 1.5 page. Like that, I have summarized all the important points. Okay, this you can have a look at it as a quick referencer just before the examination, right? So that is one aspect. Now the idea what we have done is I have selected some important questions and we'll be doing one session from 10 o'clock to 1 o'clock. 1 to 2 will be the lunch break and 2 to 5 again we'll continue with the sessions. Okay, so to begin with, we'll start with Ind AS 2. I know it's an easy standard, but I was surprised to know that a lot of students were not able to solve it properly in the previous attempt. Now, one thing students feel that, sir, Ind AS 2 was tested in the previous attempt, so will they be tested again? We never know. Okay, they may ask for a 2 marks MCQ. Even 2 marks are important. So coming to Ind AS 2, what we have is a very simple thing, that is Ind AS 2 talks about inventories and we are supposed to value the finished goods at cost or NRV. This all of us know, whichever is lower. Raw material are always valued at cost unless the finished goods in which they are incorporated are expected to be sold below cost. In that case, you will check cost or replacement cost. Now, this is the single table that you need to remember as far as cost of inventory is concerned. What all are included and what are excluded. Important thing, abnormal losses are always excluded. Normal losses are included. Then we have joint products and byproducts. For joint products, costs are allocated based on NRV at split of point. So we will compute what is the net realizable value at split of point and accordingly split the cost. Byproducts, if immaterial, we will reduce from joint cost, and if material, they are treated as joint products. This was one question which was tested in the May 25 attempt as well. Now, coming to the important questions. A company produced 1 lakh units of a high precision equipment each year over the past several years. Due to lack of demand and competition, it produced only 50,000 units. Further information is given below. Now, in this question, what is the only adjustment we need to look for? What is the treatment of fixed overhead? As far as fixed overheads are concerned, we compute something called as overhead recovery rate. If actual production is less than planned production, we do not change this rate. If actual production is more than the planned production, then we change the rate. Now in this case, what has happened? 1 lakh unit is the normal thing, 50,000 units is the revised production. So it has reduced. Will we revise the overhead recovery rate? We will not revise. So fixed overhead 1 crore will be allocated on 1 lakh unit at 100 per unit. Out of this, 50,000 will be added to the cost of inventory. The balance will be expensed off. Sir, what about fixed factory selling overhead? Selling expenses are not treated as part of inventory. So here the only treatment you have to be careful is when the actual production is less than the planned production, we do not change the overhead recovery rate. Apart from that, remaining things you can understand. Then this was the question which have been tested multiple times. Still I will do this because this concept you have to be clear with. Maybe in IBS they may ask this similar type of concept. In a manufacturing process, one byproduct BP emerges besides two main product MP1, MP2 apart from scrap. BP, what we have to do, whatever is the NRV, we will reduce from the joint cost. Scrap, whatever is the NRV, we will reduce from the joint cost. Detail of cost of productions are given below. So they have given raw material, they have given wages, fixed overhead, variable overhead. This is the cost of production. They have given output 5,000 and 4,000 for main product, 2,000 for byproduct and closing stock. Average market price of MP1 and MP2 is 60 and 50 per unit respectively. Why is this given? So that we can calculate the net realizable value or sales value at split of point. So what we need to do, whenever we see a joint product, 5,000 into 60, 3 lakhs, 4,000 into 50, 2 lakhs. So 3 lakhs and 2 lakhs is the sales value. As far as cost is concerned, we'll take all the cost. From that cost, we will reduce the net realizable value of the byproduct and the scrap. What is the NRV of byproduct? Byproduct is sold at 20 per unit. There is a profit of 5,000 on sale of byproduct. Separate processing charges of 8,000, packing charges of 2,000. Now here a lot of students make a mistake by reducing the profit element as well. We are not bothered about profit. What we are bothered about, how much is the net realizable value? Net realizable value is 2000 units produced multiplied by sold at 20 per unit into 20 minus 8,000 and 2,000. So this is the net realizable value which we will reduce from the joint cost. Okay. Then how much is this? 40,000 minus 10,000, we will reduce 30,000. NRV of scrap will also be reduced. So total reduction is 35,000. Total cost minus NRV, you will get the joint cost. This 320 will be allocated in the ratio of 3 lakhs and 2 lakhs, that is 3:2. After that, you get the joint cost for each of the product. Divide by number of units, you get the per unit cost. This multiplied by the closing stock, you will get the value of closing stock. Don't forget to do the total as well. Okay. Whatever is the value of closing stock, do the total as well in the examination on the safer side. Then we have one more question. This is related to NRV which has changed subsequently. Okay. On 31st December, inventory of ABC includes spare parts which it had been supplying to a number of different customers for some years. Cost of the spare part is 10 million. Okay. Please note 10 million means 6 zeros after 10. Please be aware, because institute sadly has this habit of giving some number in millions, giving some number in lakhs, and students get confused. Based on retail prices on 31st March, expected selling price of the spare part is 12 million. On 15th April, due to market fluctuation, expected selling price of the spare part reduced to 8 million. Estimated selling expense required to make the sales would be 0.5 million. What is NRV? NRV is equal to expected selling price minus cost to sell and cost to complete. Now in this case, the question is, should we consider the NRV or the sale value on 31st of March, or should we consider on 15th of April? Now that depends on an assumption as to whether the actual selling price on 15th of April, does that give me additional information of conditions existing on the balance sheet date? If the answer is yes, then of course we will take 15th April as the value and we will do it. If the answer is no, we will take 31st March and then do it. So on 31st March, selling price 12 minus 0.5, this is 11.5. So 11.5 is more than cost, we will value it at cost. However, if we assume that yes, whatever has happened subsequently, that is because of changes in circumstances, then we will consider 8 minus 0.5, 7.5 as the value of inventory. And where will the difference go? The difference will go to the P&L. Then again another one, full capacity 10,000, normal capacity 7,500 and actual labor is 6,500. What do we do? 10,000 is not relevant. Please keep this in mind. 7,500 normal capacity, based on that we will do fixed overhead divided by 7,500. Whatever is the rate, that is the rate that will be allocated to the cost of inventory. Actually 6,500. What about balance 100? The balance 100 will be charged to P&L. The balance 100, whatever is the cost for remaining 100 will be charged to P&L. So here fixed production overhead is 1500. So 1500 divided by 7,500 is 0.2 per hour. Okay. How many hours have been worked? 6,500. And please note here, the capacity is 10,000 labor hours, normal capacity is 7,500. So for 6,500 into 0.2, 1,300 will be added to inventory. What about the balance? Balance will be expensed off. Okay, so that is one thing you have to keep in mind in this question. Here we have a firm contract. Now, whenever we have a firm contract, okay, what we need to do, out of the total inventory, firm contract we will take firm rate, and for balance contract we will take the expected selling price. So let us look at this. And yes, students, if you have any question in between, if you feel something is not clear, you want me to repeat, please put it down in the comment section and I'll be more than happy to solve that for you. At the end of the financial year, company P has 100 units of inventory on hand recorded at a carrying amount of 10, means 10 is the cost. Current market price is 8 and company P has a firm sales contract with company Q to sell 60 units at 11 per unit, which cannot be settled net. What does that mean? That means that I have to settle that amount by settle that contract by delivering inventory. So how do I do the valuation? See, for 60 units I have to do separately and for 40 units I have to do separately. 60 units NRV is 11. Acha, incremental cost to sell is 1. So NRV is 10. And for the remaining product which you can sell at 8 per unit, NRV is 7. So whatever can be sold to company Q, you will value at 10. Whatever are the remaining, you will value it at 7 and accordingly to the valuation. This was one question which they have had included once with the RTP. Here they are asking us to calculate based on the percentage method. So you can we'll have a look at this quickly. Entity has following details regarding cost and retail price of the goods purchased and unsold at the beginning of the year. Opening inventory cost is 6250, retail price is 8000. Purchases 19500, retail price is 34000. Inventory on hand 23000 based on retail prices and sales for the period 19,000. Calculate percentage of cost price over retail price. Now how do we do this? See, we have to see what is the total cost. Total cost is 6250 and 19500. So the total cost is 25,750. Sale value 42,000. So cost percentage of retail price is 61.31%. Percentage of cost price over retail price 61.31%. Cost of closing inventory. See, inventory on hand is 23,000. Inventory on hand is 23,000. How much is the cost? 61%. So that will be the cost. Value of cost of sales. This you will use opening stock plus purchases minus closing stock formula and you will get the number. Okay, so the total cost minus closing inventory, and profit, sales minus cost of goods sold will give you the profit. Okay, so that's it with Ind AS 2. With this we have also covered the important parts that are required to be done. Now moving to Ind AS 16. Now as far as Ind AS 16 is concerned, one thing that you have to keep in mind is the definition part. A lot of time theory question is asked in the examination and you need to write down this theory properly. So please remember this. We will recognize the cost of an item as an asset if it is probable that future economic benefits will flow to the entity and the cost can be measured reliably. Generally, this second condition is met. There is no confusion as to the second condition. Generally, when you are buying or when we are exchanging some asset, cost can be measured reliably. You have to prove future economic benefits will flow to the entity, and it has to be an asset, means there also needs to be control. Okay, then this table again similar to what we have done in Ind AS 2. This table you need to remember what all are included, what all are excluded. Here this is one important point, a recent amendment. If net sale proceeds is greater than the cost of testing, then amount is deducted from the cost. We will not take the excess value to the P&L. The amount is deducted from the cost. So when we are launching a PPE or whenever we are making the PPE ready for use, if at all there are costs which are being incurred for testing and the actual sale proceeds during the testing period is more than the cost, that will be reduced. It will be treated as a negative item from the PPE cost. Important thing, keep in mind. Then present value is done, and any cost which is required to bring the asset to the location and condition to operate for its purpose intended by the management. This also you need to remember, because a lot of time theory questions are given where you can include this particular concept. What are excluded? Cost of conducting business in a new location, cost incurred to introduce a new product, new facility opening cost, and administrative and other general overheads. As far as self-constructed PPE is concerned, we will take only the cost component. Any profit element is there, that profit element we will not consider. Sometimes the question will tell you Department A bills to Department B at 110% of the cost, or market price is so much, cost price is so much. What we will do? We will take only the cost price. We will exclude all the internal profit and any abnormal amount of wasted material, labor or other resources. Then exchange of non-monetary asset. If there is commercial substance, we will always take the fair value of asset given up as the first priority, or if that is not there, fair value of asset acquired as the second priority. Sir, if there is no commercial substance, in that case, what we will do? We will take the carrying amount of asset given up, or if the fair value cannot be determined, in that case also we will take the carrying amount of asset given up. Subsequent costs are always charged to P&L if there is replacement of major part. For example, there is replacement of chairs of an aircraft, or if there are major inspection and overhauling cost, then existing component we will de-recognize, new component we will recognize. If the PP has two or more significant component, we will follow the component depreciation, that is depreciate each of the components separately over the useful life. When revaluation model is followed, first time upward we will credit to OCI, first time downwards we will debit to P&L. Subsequently, what we will see, if it was credited to OCI and subsequently we have to do a downward revaluation, we will see what is the balance available in OCI. How much is the balance available in OCI? First you will debit OCI, and balance you will write it off from the P&L. You may think, sir, these are simple points, why am I repeating? I am repeating because I have seen students in examination pressure forgetting these points in the examination. Okay. Then if there is a downward revaluation subsequently, if earlier it was upward, so first you will debit to OCI and then you will debit to P&L. If it is a subsequent upward revaluation, earlier if there was a downward revaluation, first you will debit to P&L and then you will debit to, first you will credit to P&L, then you will credit to OCI. Decommissioning liability, present value of decommissioning liability is added to cost of PPE. If cost model is followed, changes in liability is added or deducted from carrying amount. If revaluation model is followed, we will treat it as a revaluation changes. Okay. So let us look at questions now. On 1st April, a company acquired a machine under the following terms. List price, include the cost. Import duty, include the cost. Only refundable duties and taxes and GST will be reduced. Delivery fees include. Electrical installation include. Pre-production testing include. Purchase of 5-year maintenance contract. Now, if a 5-year maintenance contract is given, then this is not related to purchase of the machinery. This we will expense over a period of 5 years. In addition to the above information, XYZ was granted a trade discount of 10% on the initial list price. So whatever is the list price, from this we will reduce 10%, and a settlement discount of 5% if payment for the machine was received within 1 month. Now always remember, cash discount is not reduced. What is a trade discount? What is a cash discount? Trade discount is agreed at the time of trade. Cash discount is given for prompt payment. So cash discount is never reduced, only trade discount is reduced. That is the only important thing in this particular question. Moon Limited incurs the following cost in relation to construction of a factory and introduction of product to the market. You are required to calculate the amount as per Ind AS 16 for capitalization. Site preparation, material, labor, including 10,000 incurred during an industrial strike. This is what? Abnormal. Any abnormal loss we will exclude. Testing of various processes, consultancy fee, relocation of staff. If I am moving staff from one location to another location, that does not add any value to the factory. That is for operational purposes. So this will be excluded. General overheads and estimated cost to dismantle. Now here, general overheads will not be considered because those are not given to have been incurred for the construction of the factory. Relocation of staff will also not be considered. Then sometimes in the examination you will get estimated cost to dismantle. The question doesn't say whether it is a present value or future value. So in that case, you can make an assumption that it is given to be present value and you can accordingly do it. Or if information is available, that is what is the percentage discount, what is the number of years, if that information is available, you will take that information and do it. Okay. General overheads will not be considered, that you have to keep in mind. Then this is for exchange. Pluto Limited owns land and building which are carried in its balance sheet at an aggregate carrying amount of 10 million. Fair value of asset is 15 million. Exchanges the land and building for a private jet. Does this have commercial substance? Generally, when two different type of assets are exchanged, it has commercial substance. Okay, which has a fair value of 20 million and pays additional 3 million in cash. So what is given up? Fair value of asset given up. What is fair value of asset given up? 15 million plus you have given up cash 3 million. So 18 million will be the total value of the new property, plant and equipment that you have acquired in exchange. So to new property, plant and equipment 18 million. What did we give? We give cash of 3. So you will credit cash or bank account 3 lakhs. Then what else did we give? Jet we gave at 15 million. But 15 million is the fair value. What is the carrying value? Carrying value is 10 million. So profit element is how much? Profit element is 5 million. So we will book a profit of 5 million and credit PPE existing one for 10 million and bank account 3 lakhs. Okay. This is with respect to your significant overhauling and repair cost. Can you repeat the overhead? Yeah. So if there is any directly attributable cost to bring the asset to the location and condition necessary to operate as required by the management, you will include. If you have, let us say, overhead which is incurred for, let us say, the factory purpose, that you will include. But if there is an allocation of general overhead, some corporate overhead, corporate head office expenses which are allocated, okay, those allocation of overheads are not included. If it is directly attributable, if you can allocate it on a reasonable basis, then yes. For example, if you are constructing a factory and there is a security guard who is supervising the construction of the factory, that is an overhead which you will include. But some head office expenses and all, that we will not include. Okay, so coming back. Now the next question what we are discussing is for shipping. Now as far as shipping is concerned, now in this case there is an overhaul. Overhaul means major repair. Okay, now here what does it say? A shipping company is required by law to bring all ships into dry dock every 5 years for a major inspection and overhaul. So it's a major inspection cost. Always remember, if there is a major inspection cost, initial major inspection cost, whatever is there, that we will not be aware of. Subsequently, whatever major inspections are there, we will capitalize. Okay. A ship costs 20 million with a 20-year life must have major overhaul every 5 years. So initially how much did we purchase at 20? The estimated cost to overhaul at the 5-year point is 5 million. Actual cost turns out to 6 million. So initially we estimated after 5 years the cost will be 5 million. Okay. Now when we purchase this 20 million, the ship is in a working condition. So what we assume, this includes overhauled component also. So what we will do, the 20 million cost will split between overhaul component and other component in this way. That is 5 million for overhaul, 15 million for cost of the ship. This has a life of 20 years, so every year will depreciate 0.75 million. This has a life of 5 years, every year will depreciate 1 million. At the end of 5 years, this overhaul component will become 0. And we will incur of new overhaul component of 6. On that 6, over a period of 5 years, we will depreciate 1.2. Okay. So, what has happened? Other components are being depreciated over a period of 20 years. Overhaul component is depreciated over a period of 5 years. A lot of students sometimes get confused as to, sir, we are not paying this overhaul cost initially. Why are we calculating it this way? The basic idea is the ship is in a working condition, means it is in an overhauled condition. So whenever I buy a new ship, the 5 million of overhaul is already incurred when the new ship is manufactured. So that's how we are splitting the two things. Okay, then an entity acquired an asset 3 years ago at a cost of 5 million. Depreciation method adopted was reducing balance method. At the end of year 3, entity estimates that the remaining life is 8 years and determines to adopt straight line method from that date. Show the necessary treatment and calculate the depreciation charge. Very simple. Whenever there is a change in accounting estimate, now what are the estimates? Change in useful life, change in residual value, these are called change in estimates. So those are accounted for prospectively. Not only that, change from WDV method to SLM method, that is also accounted for prospectively. Actually speaking, this is an accounting policy change, but because this includes change in policy, change in estimates, everything, and it requires a lot of effort to do a retrospective application, WDV to SLM is considered as change in accounting estimates only. So how will we do this? First, you will calculate for 3 years as per reducing balance method. So opening balance 50 lakhs, 5 lakhs of depreciation, 45 lakhs. Then 45 lakhs, 10 per 450 of depreciation, and then another depreciation 3645. From that date, what we will do, we will take 3645 remaining 8 years useful life, and on a per annum basis we will calculate the depreciation using the straight line method. Here is a case of component accounting where initially we don't have the cost of component. MS Limited has acquired a heavy machinery at a cost of 1 crore with no breakdown of the component parts. The estimated useful life is 10 years. At the end of the 6th year, one of the major components, the turbine, requires replacement as further maintenance is uneconomical. The remainder of the machine is perfect and is expected to last for 4 years. Cost of new turbine is 45 lakhs. Discount rate is 5%. Can the cost of new turbine be recognized as an asset, and what is the treatment? Now typically when sometimes assets have different components, asset has different components, right? Now those different components, if we need to replace a major component, then the carrying amount of existing component is de-recognized and the cost of new component is recognized. But here the problem is we have given a single payment of 1 crore. How do we do that? How do we compute the cost of turbine separately? So in that case we will make an estimate. What is the estimate? See, after some time when it was replaced, we incurred a cost of 45 lakhs. This is future value. Now what we will do, we will work back and see what would have been its cost after or before 6 years. Okay, so this is for the cost of 6th year. If 6th year cost is 45 lakhs and 5% is the discount rate, what would have been the value at year 0? Simple, 45 lakhs divided by 1.05 to the power of 6. This will give me the approximate value of what? Approximate value of the turbine at the beginning of year 0 or when we purchase the asset. So that number is 33 lakhs 57,900. How much did we pay? 1 crore. Out of 1 crore payment, what we are saying is, out of 1 crore payment, the turbine cost is 33,57,900. Turbine cost is 33,57,900 and the balance amount pertains to remaining asset. So we will depreciate it per year considering what useful life? See, initially we did not know the life was 6 years. So we will depreciate considering 10-year useful life. So every year we will charge 3,35,000 for turbine and totally 10 lakhs. For 6 years, this is the depreciation and the carrying amount becomes 1343 at the end of 6 years and 40 lakhs for the turbine. On this date, the turbine becomes useless. So what we will do? We will de-recognize. When we de-recognize, we will reduce it from the cost of the asset totally. Then new turbine is purchased, we will add it to the cost of the PPE and this becomes the new value of PPE, and subsequently considering this we will depreciate the the total property, plant and equipment. I hope it is clear. This and the overhaul cost part what we discussed, these are where students tend to get sometimes confused as to what is done. So it is good that you revise it properly. So this is another case where we have various cost givens. So land including legal cost, is it capitalized? Yes. it is a separate cost. Preparation and leveling of land, yes, capitalized. Materials capitalized. Construction workers. So here they have given that construction worker cost is 2 lakh per month. Construction work commenced on 1st of May and it was completed on 30th of November. So May, June, July, August, September, October, November. 7 months cost is capitalized. Direct overhead, someone had asked, right? Naga Sairam, you had asked, which overhead to consider. Direct overhead we will consider, allocated overhead we will not consider. Temporary income, whatever is generated by using that asset will be credited to P&L. Relocation cost is not considered. Opening ceremony, ribbon cutting ceremony, not considered. Borrowing cost will consider for, now here, see they have not given specifically, the borrowing. If you see, the factory was completed on this date, which is considered a substantial period of time. Now, two assumptions are possible. If they have taken specific borrowing, then from 1st April itself, you will capitalize. But if you assume that no, this is not a specific borrowing, this is a general borrowing and, land is already ready to use. So there are two assumptions possible. Land, Aryaman, how much theory is needed to be written in these type of questions? Excellent session. Thank you, Aryaman. I think you are one of the students who had requested, so I thought I'll plan it in this way. Yeah, how much theory is to be written? If it is 5 marks question, 6 mark question, and if it is calculate, then don't write extra theory. Where we have to give treatment like this, treatment like this. Give a brief theory, subsequently why it is considered. Okay, so that is how we will do the answer. Right? Yeah. So here we will see in this case, if we assume land is already ready to use and we did not need the building on top of the land, then that 1st April will not consider, will consider from 1st of May, and the book has also considered, the study material has also considered from 1st of May. If there are specific borrowings, we will take the total borrowing period. That is one thing you have to keep in mind. Okay. Now, here one more thing what you have to understand is, the production began on 1st of February, that is when actual usage happened. The factory was completed on 30th December. Overall useful life of the factory was estimated at 40 years from the date of completion. However, it is estimated that roof will need to be replaced 20 years after the date of completion, and the cost of replacing the roof at current prices would be 30% of cost of the building. Now here, one very important thing that you have to understand, there is a land component, there is a building component. In building component, we have roof component separately and the other component separately. So roof we will compute and depreciate it over a period of 20 years, and factory building remaining part we will depreciate over a period of 40 years. Okay, so that's how we will do the split. So total cost, land is 10,000, then depreciable component other than land is 9912, that is the cost of building. Of that, 30% is roof, balance is the other party, other component. Okay. Second, actual production started in February, but it was ready to use in November end. So December, January, February, March, 4 months depreciation will be calculated. Okay, so that is one more thing you have to keep in mind. This is some extra information if you want to understand further, right? Then this question you can do it on your own. I have already explained. This is about revaluation. Okay. In revaluation case, always remember first time revaluation OCI, subsequent revaluation if it is increase, again OCI. If it is decrease, first debit the OCI, balance will go to P&L. Okay. Using that concept, you can practice question number 12 and question number 13 on your own. Okay. Where this will be more for your own practice and revision. One more thing, for revaluation cases, whatever is the revaluation surplus, what is the treatment? Entity has two choices. One, transfer to retained earnings every year, or at the end. Okay, the question will tell you whether the entity is transferring at the end of every year or whether it is transferring at the end of the period. Now, if it is transferring to the retained earnings at the end of the every year, how do we compute that? Original depreciation and revised depreciation, whatever is the difference, the difference between these two will be debited to OCI or revaluation surplus and transferred to retained earnings. Never we will take this to P&L. Please keep this in mind. Don't make these mistakes in the examination. Okay, directly from this you will transfer to retained earnings based on the difference. Then whenever there are decommissioning cost and if there are changes to decommissioning cost, what do? Changes to decommissioning cost, if you are following cost model, then you will add or you will reduce to the cost of PPE. If the liability increases, we will credit the liability and we will debit the PPE. If the liability reduces, we will debit the liability, reduce the PPE. Please note, PPE amount cannot be negative. So if liability reduction is more than PPE amount, the balance amount will be taken to income statement. If revaluation model is being followed, then what do? Whatever are the changes in the liability will be considered as a change to the revaluation surplus. Meaning to say, if liability increases, means what? The liability has increased, I have to credit the liability. What will I debit? I will not debit the PPE because PPE is already at fair value. I will debit the revaluation surplus. And exactly opposite if the liability reduces. H Limited purchased an item of PPE costing 100 million which has useful life of 10 years. The entity has contractual decommissioning and site restoration obligation at 5 million to be incurred at the end of 10th year. Current market based discount rate is 8%. Company follows SLM method. They follow the cost model. Determine the carrying amount of PPE and decommissioning liability at each year end when there is no change in the liability and the discount. Second case, at the end of year 4, entity expects that the estimated cash outflow on account of decommissioning and site restoration to be incurred at the end of the useful life will be 8 million instead of 5 million. How will H account for the decommissioning liability? So here is where you have to be slightly careful. First part of it you can handle. Okay. So 8%, how many factors to take? That is one more doubt you will have. If the question has given, even I have made a mistake while I was teaching once. Question gave 2 decimal. I took 3 decimal. Okay. So don't calculate on your own if the present value factor is given to you. Otherwise take 3 factors. Okay. So current market based discount is 8%. So if you take 8%, 1.08 divided by to the power of 10, the present value becomes 2.3106 million. Now if you are not comfortable in handling decimals, my advice to you is, if it is what, how much is this, 5 million, right? You write 5 million and do the calculation so that you don't make mistakes in the examination. Okay. So cost is 100 million, present value is 2.3, opening balance is 102. Depreciation every year, straight line basis, and carrying amount is this. Decommissioning liability 2.316, every year we'll add 8% and we'll get to the closing balance. So this is the first part. Second part is, at the end of year 4, entity expects that the outflow on account of decommissioning will be 8 million. So what happened? 1 is done, 2 is done, 3 is done, 4 is done. Here they are saying now it will be 8 million. Now if it becomes 8 million, how many years are left? 4 years are gone, 6 years are left. So then we will calculate 8 million 6 years discounted at 8%. We get how much? 5.0414. This current carrying amount is how much? 3.15. The difference between these two is increase in liability. I have to credit the liability. What will I debit? I will debit the PPE. So we'll debit the PPE account and credit the provision for decommissioning account. From that date onwards, PPE calculation will also change and decommissioning liability calculation will also be changed. Sir, what if revaluation model was followed? If revaluation model was followed, then PPE would not come into picture. Revaluation surplus would come into picture. It will be a change to the revaluation surplus. This one again a very interesting question, and surprisingly ICAI has not been testing these type of questions recently. They are giving simple questions on calculate the depreciation, calculate the impairment and all of that. changes in decommissioning liability, if at all it comes, it can be actually a make or break for a lot of students. And one thing, and as I've been discussing, if you come across a question, and this I have told earlier also, if you come across a question which is new to you, the question is new to you, it appears new to you because maybe you have not revised or you have not done it before, do that question at the end. Okay, don't get scared because you get a new question in the examination. Do it towards the end. Entity has a nuclear power plant and decommissioning liability. Nuclear plant started operations in 1st of April. Plant has a useful life of 40 years. Initial cost was 120. Included decommissioning cost of 10,000, which represents 70,400 in estimated cash flows in 40 years, discounted at a rate of 5%. So we need to pay 7,500. Present value is how much? 10,000, already included here. Okay, see this included. Please read the question carefully. The entity's year ends on 31st March. Assume that market-based discounted cash flow valuation of 1,15,000 is obtained on 31st March of year 4. When did we start? Year 1. How many years? Don't say 4. Years are 3. 2, 3 and 4. The valuation is after deduction of an allowance of 11,600 for decommissioning cost. Now in this question what happens is, initial it is 10,000. After 3 years, what should be the valuation? 1.05 to the power of 3. So 10,000 into 1.05, 1, 2, 3. Sorry, 10,000. 1.05 into 1, 2, 3 into 10,000 if you do, you get 12,150. Which represents no change in original estimate after unwinding 3 years of discount. So originally it was 10,000 into 1.05 into 1.05 into 1.05. If I do, I get 11,576, and they have rounded it off to 11,600. So sometimes the question may include rounding off. Okay. Yes, Anup, the video will be saved, and you can come back and have a look at the respective chapter whenever you want to. 11,576, but here they have rounded off to 11,600. Be careful while doing these type of questions. So no change in unwinding of discount. Now what has happened here? They have got a valuation of 1,15,000 after deducting decommissioning liability. But when we do the fair valuation, we have to consider the gross amount. So my gross amount will be 115 plus 11,600. 115 plus 11,600, 1,26,600. This is the revalued amount. What is the carrying amount? 1,11,000. Carrying amount, all of you can calculate. The difference will be revaluation surplus transferred to OCI. After that, every year depreciation will be 3420, which is 126,600 divided by 37 years. And please be mindful, these kind of questions are likely to be tested in IBS also. I have seen there's a lot of focus on complex questions being tested as a part of IBS, and it can be highly scoring for you. Alright. Then on 31st March, entity estimates that as a result of technological advances, present value of decommissioning liability has decreased by 5,000. Not the final liability. Present value of liability has decreased. When? 31st March of year 5, after 1 year. The entity decides full valuation of asset is needed, and the value is 1,07,000 after reducing the decommissioning liability. Now, this 11,600 after 1 year will be how much? 12,200. Now they're saying there is a reduction of 5,000, so it becomes 7,200. So the liability has reduced to 7,200. Then revalued amount net of obligation is how much? 1,07,000. On that, if you add the obligation, it becomes 1,14,200. This, and if you compare the carrying amount, what is the carrying amount? Carrying amount is 123. So difference is downward revaluation. This calculation, if you have done properly, then subsequently changes will not be a problem. So as I told you, if there is a reduction in liability, we will debit the liability, and accordingly we will credit the revaluation surplus. Alright. So that was one thing where you have to be careful. These two questions are worth self-practice before the examination. Right. So this has, I've covered important questions from Ind AS 16. See, basic questions involving calculations of amount, right? Like what should be the amount at which the PPE should be calculated. So what I'm saying is this one. If you get these type of questions, no, 100% you should do. And the reason why I'm saying you should do is, see, you may make 1 or 2 mistakes, but remaining items you will get marks. So definitely you should attempt the question. Okay, then moving to Ind AS 38. Now as far as Ind AS 38, just a moment, sorry. Yeah. Moving to Ind AS 38, as far as Ind AS 38 is concerned, one, the recognition criteria is important. For theory questions, recognition criteria is very, very important. So you will have to write down what is the recognition criteria. Okay. So to be an intangible asset, it has to be non-monetary, non-physical, identifiable, and it should meet the recognition criteria, future economic benefit, and cost to be measured reliably. Initial costs are capitalized, subsequent costs are expensed, only capitalized if you get future economic benefit. Then, for internally generated intangible asset, research expense are not recognized. That is the first thing. Second, goodwill, brand, mastheads, publishing title, customer list, and similar items, these are also not recognized. Okay. Expenditure always expense, research expenditure, startup cost, training cost, etc. Development cost is capitalized if these conditions are satisfied. Please revisit these conditions again and again. Technical feasibility, you have want to complete, future economic benefit will come, you have the resources to complete, you have the ability to use or sell, and measurement is possible reliably. Amortization, goodwill is not amortized. Goodwill is never amortized. Rather, it is tested for impairment as per Ind AS 36 and Ind AS 103 combined reading. Others, over a useful life, either using SLM basis or output basis. Useful life, if it is finite, will amortize. If it is indefinite, no amortization. Indefinite, like if the value of the life of intangible assets cannot be defined, then you will not amortize. What will you do in that case? You will take it for impairment. Okay. Cost of renewal, significant. If it is significant, considering future economic benefits, treat it as a separate intangible asset, otherwise expense it. Okay. Ind AS 40, almost everything is same. Only thing that you have to keep in mind is, as compared to Ind AS 16, Ind AS 40, what you have to keep in mind is fair value is not permitted, and the disclosure requirement. Okay, so there is one question on disclosure requirement. That is one thing you have to see. And whenever there are transfers from Ind AS 40 to 16, you will transfer at carrying amount. 42 to carrying amount. Every transfers will happen at carrying amount only. Okay. So let us look at questions from both the standards now. Intangible assets, generally we get theory questions from this. Okay, so some questions I picked to cover the relevant concepts as well. Okay, so for example, company has completed big marketing and advertising campaign. Whenever there is no identifiable intangible asset being created, if you do not get anything in the future, we will not capitalize that. We will not capitalize that. Okay, very simple. And this, in interim financial statements also, sometimes they'll say huge expenditure incurred, the company wants to capitalize. Can we capitalize? No, we cannot capitalize. The finance director had authorized this campaign and it will create 5,000 of profit. See, these are estimates. Do I have control over these benefits? No. Can I say that because of this advertisement so many people will come and buy? No. So this will not be considered. New product was developed during the year. Expenditure aggregate 1,50,000, of which 1 lakh was incurred prior to 30th September, the date on which it became clear that the product was technically viable. New product will be launched in the next 4 months and recoverable amount is 70,000. Now here, in these type of case, two things you have to keep in mind. One, an expenditure which has been incurred and expensed, research expense, already expensed, you will not recapitalize that expenditure. Okay, whatever happens, you will not recapitalize that expenditure. First. Second, research phase, 1 lakh, expense completely, no need to recapitalize. Total expenditure 150, 1 lakh is expense, 50,000 will be capitalized. Recoverable amount is 70. If recoverable amount is 70, no problem. If recoverable amount is 40, you will write it off 10,000 as impairment. Okay. Staff participated in training program. All of these, staff related expenses, salary, training, and all of those, we will not capitalize as an intangible asset unless cost of that salary is being incurred for some future, for some other intangible asset or for some other tangible asset. Exchanges, again, you can have a look at it. That same principle what we have seen in the previous thing, you can have it. Here, what I was saying, expenditure incurred was 1,000, 900 was incurred before 1st of March, 100 was incurred between 1st and 31st of March. Demonstration that it will be an intangible asset is 1st of March. So 900 expense, only 100 you will capitalize. The recoverable amount is estimated to be 500. During year 2-3, expenditure of 2,000 was incurred. At the end of year 3, recoverable amount is 1,900. So first, 100 is capitalized. Recoverable amount is more than that, so no need to impair. Subsequently, total amount of 2,000 is capitalized, so we have 2,100. Recoverable amount is only 1,900, so 200 will be expensed as impairment loss. These type of questions are also typically tested in the examination. Engage in the business of manufacturing fertilizers with a technical collaboration, no problem. They provide technical know-how, okay. They paid how much? 10 crores. This is the intangible asset, and the output is expected to be like this. So every year you will do the amortization considering this output. Means 10 crores divided by, what is the total? 50, 70, no. Total is 450 initially. So considering 450, you will do the amortization. Now comes the point where there is a change in estimate. At the end of first year, it achieved its target production. Okay, no problem. At the end of second year, 65,000 metric tons of fertilizer was being manufactured, and they considered to revise the estimate as 85, 105, 115. How will they amortize? Now here, a lot of students get confused as to, sir, second year should be based on 70,000 or 65,000. Always remember, once in a particular year, the number has changed. So that year number, you will check the changed number only. So second year, you will take 65,000. 85, 105, 115. 85, 105 and 115. These are the numbers you will take. So 65 plus 85 plus 105 plus 115. You will amortize it considering 370 only. So first year amortization is based on 50,000. Carrying amount is this much. Second year onwards, you will take 370 and then do the amortization. Okay. This is something where you can make mistakes in the examination. Then again, advertisement campaign, it will not be capitalized. 4-year license to manufacture at a cost. Production commenced immediately. Yes, we will capitalize. Another company purchased at the start of year. They acquired a brand with a fair value 3 crores based on sales revenue. The life of the brand is 15 years. Now, they have a brand and fair value can be identified. That will be capitalized. Okay. Then, advertising campaign will not be capitalized. Development. It commenced developing a new drug. Project cost would be 10 crores. Clinical trial proved successful and it is expected to generate over 5 years. So this also will capitalize, assuming that it will give us future benefits. Then here some questions have, they paid 30 lakhs for obtaining skilled staff of Y Limited. Always remember, staff I cannot control, so I cannot capitalize this. Sir, where will this amount go? This will be included in goodwill automatically. So as per Ind AS 103, when we have goodwill calculation, what do we take? We take fair value of net identifiable or identifiable net assets. This staff is not an identifiable net asset. So anything you pay towards that actually sits into goodwill calculation. Okay. So that is one thing you have to keep in mind. 50 lakhs by way of payment towards non-compete fee so as to restrict Y Limited to compete in the same line of business. Now, this 50 lakhs that I am paying to another entity, am I getting some right out of it? Yes. Can I enforce that right? Yes. Is it out of a contract? Yes. Hence, it becomes a separate asset. So, 50 lakhs becomes a separate asset. 30 lakhs gets added to the goodwill calculation. Okay. Then research and development, you can understand. But yes, so here X acquired Y on 30th April, purchase consideration 50 lakhs, fair value of tangible asset is 45, estimates the fair value of in process research 10 lakhs, no other intangible asset is acquired. Now, one thing when we go to business combination, and yes, if you want to revise business combination, important question, consolidation, important question, and financial instrument, important question, that in about 2 hours each, I've done separate videos, you can have a look at that. Now here what has happened is, we have paid something to acquire what? In process research project. Now if there is something to acquire in process research project, can we capitalize that? Now please understand, the company which has incurred the research expenses, they cannot capitalize. But if some other company is acquiring that research work done, they are attributing some value to the research work, so this will be capitalized separately at fair value of 10 lakhs. Subsequent research expenses, you will not capitalize. 2 lakhs to establish technical feasibility, you will not capitalize. 7 lakhs will be capitalized. X Limited purchased a patent on 1st of April of 3 lakhs, which had a legal life of 15 years. Due to competitive nature, the management estimates the useful life only 5. So we'll depreciate over 5. Straight line is determined. Okay. 1st April, they are uncertain that the process can actually be made economically feasible and decide to write down the patent to an estimated market value of 150 and decide to amortize over 2 years. Now these are simple questions. Okay. You have to be very careful while calculating. It is not that you do not know this concept. See here, you have been doing this since CA Inter also. So you will be able to do this question. Calculation mistakes should be avoided. Okay. So now here, what they have said, legal life of 15 years, but we will depreciate over 5 years. So 3 lakhs divided by 5, depreciation is 6, amortization is 60. On 1st April of year 2, means after 1 year. So the carrying amount will become 2 lakh 40. Then we have written it down to 150. This difference is called what? This is impairment as per Ind AS 36. Loss will be debited to P&L. Subsequent amortization 2 years only. So 75,000 each. On 1st April, having perfected the production process, asset is now appraised at a value of 3 lakhs. So next year, now they are writing it back to 3 lakhs. Carrying amount was how much? 75,000. This 2,25,000 will be reversed. The estimated useful life is now believed to be 4 more years. Now, whenever you are reversing this, gain, okay, whenever you are reversing this gain, you have to be careful as to what is the maximum amount of revaluation that can happen. Okay, so that is one thing you have to consider. Here in this question, what they have done and what the study material has done is, instead of calling this as an impairment loss, they are assuming it is a fair value model being followed or the revaluation model being followed. Okay, so that is one thing you have to keep in mind. One of the senior engineers in XYZ has been working on a process to improve manufacturing efficiency and reduce the manufacturing cost. Senior engineer believes the cost reduction will exceed the project cost. All these are GAN. Regulatory testing and health safety approval was obtained on 1st of June of 25, year 5. This removed uncertainties concerning the project, which was finally completed on 20th April of year 6. Cost of 18 lakhs was incurred till 31st March of year 6 and they have been recognized as an intangible asset. An offer of 780 has been for the new developed technology has been received by the potential buyer, but it has been rejected. They believe that the project will be success and save the company 12 lakhs in perpetuity. When they say 12 lakhs in perpetuity, that is the value of savings. Director of Research Neha, who is qualified electronic engineer, is concerned about the long-term prospects, and she is of the opinion that competitors would have developed new technology and they would require to replace this within 4 years. The present value of future cost savings will be 960 over this period. After that, she thinks there will not be any future. Now, what has happened first is they have incurred cost of 18 lakhs for 31st March of year 6. When did they start? They start which was completed on 20th of April and approval was obtained on 1st of June. Okay, so the total cost of 18 lakhs that has been incurred, assuming it has been incurred over the entire period, For the first 2 months, April and May, I cannot capitalize because approval is received on 1st of June. So what should I do? 2 months expenditure of 3 lakhs should be expensed. So we will expense the 3 lakhs of expenditure. Okay. So carrying amount becomes 15 lakhs. Now recoverable amount are two. One, the person who has developed who says it is 12 lakhs, Utkarsh only, right? Utkarsh. And second, the director of research. Now, whose value you will give more or whose value you will have more weightage to? Of course, Neha, because she has an experience, she's an independent person. So, we'll take her valuation, which is 960. 960 and 15 lakhs. Recoverable amount is 960 and impairment loss is 5,40,000. Okay. This again, you can practice it on your own. Concepts I have already discussed, same thing that has happened. Sometimes you get questions where they say, prepare a schedule showing the intangible asset section, prepare a schedule of related expense. Now, this is where if you do not practice enough, will be difficult in the examination. You will know the numbers, but how to present? So, schedule, when they say intangible assets, follow these kind of schedule. Opening balance, gross amount, this is amortization, sorry, and net amount. Okay, this is the depreciation. And balance sheet extract you have to give. Statement of P&L you have to give, and their extract you have to give. In statement of P&L, amortization expense or any other expenses, those things also you have to give, including the revenue. Okay, working note can be given subsequently. Now, the reason why this is important is, if you know the answers, but if you are not able to present it in this format, marks will not be given. Okay, I've seen one certified copies where Ind AS balance sheet, we have assets first, right? The student has given equity and liabilities first. Amounts are correct. 4 message has got only 0. I think 4 or 3, whatever is the number. So writing it in an appropriate format is also important. So please ensure, see, calculation, there is no rocket science in this question, but presentation is a rocket science. So please have it done properly. Okay. Then moving to Ind AS 40. In Ind AS 40, see, whatever you have done in Ind AS 16, same things you can repeat here. There are 2-3 things that you have to keep in mind. One, transfer from investment property to inventory, transfer from investment property to property, plant and equipment, transfer from inventory to investment property, property, plant and equipment to your investment property. And there is one specific question on disclosure requirements. Okay, so that you have to be thorough with. Let's look at this one. X Limited, engaged in construction industry, prepares financial statement on 31st March. On 1st April, they purchased a large property consisting of land for 2 crores and began to lease the property to Y Limited on an operating lease. Lease rental is 20 lakhs. On 31st March of year 5, the fair value of the property is 2.6 crores. Under the terms of lease, Y Limited was able to cancel the lease by giving 6 months notice in writing to X Limited. Y Limited gave this notice on 31st March and vacated the property on 30th of September. On 30th of September, fair value of the property is 2.9 crores. On 1st of October, X Limited began to convert the property into 10 separate flats of equal size and intend to sell in the ordinary course of business. Spend a total of 60 lakhs on this conversion. The project was incomplete and the directors estimate they need to spend a further of 40 lakhs to complete the project, and flat could be sold at 50 lakhs. Examine how the 3 events should be reported in the financial statement. First and the foremost. Fair value. Do we do fair valuation of investment property? No. Please keep this in mind. No fair valuation. Okay, that's the first thing. Second thing, whatever lease amount has been received, so they are saying for year ended 31st March of year 6. They lease the property when? On 31st March, the fair value is given. 1st April, they purchased and they began leasing. Okay, that's okay. On 31st March, fair value is given. Okay. Under the terms, they were able to cancel. Notice was given on 31st March. So 6 months rent we have received. How much is the rental? Rental is given at 20 lakhs per annum. So for 6 months, the rent will be 10 lakhs. On SLM basis for operating leases, will recognize the income. Then after that, reclassification has happened. Reclassification will happen at cost only or carrying amount. Now here, what is purchased? Land is purchased, not building. So will land be depreciated? No. So whatever is the value, so there is no gain or loss on classification. Entire 2 crores will be considered for classification at cost basis only. Fair value will be ignored. Fair value will not be considered. Okay. Then cost of conversion 60 lakhs has been incurred. So that becomes my value of inventory. So inventory to bank. So 2 crores 60 lakhs is the cost. NRV 10 flats into 50 lakhs 5 crores minus 0.4 4.6 crores. So inventory will be valued at cost only. This was the one I was talking about. So this entire question, again, there is no rocket science in this particular question, but yes, the disclosure part and how do you give the relevant extract is very, very important, right? And whenever you get this question, no, don't get scared by the length of the question. Sometimes what happens is, Arey, such a long question, we'll do it at the end. No, because if you see the disclosure and all, these are simple and straightforward. So what is the question? The question has given, they own a building A used for the purpose of earning rentals. They have not been using A for so much time. Information is available. Initially purchased at a cost of so much. Then they follow straight line method for depreciation. They invested in another building. So one more building is there. Okay, for capital appreciation. Further, the company earned following expenditure and income. Rental income of both the things, and then expenses have been given. They don't have any restriction or contractual obligation. And then please understand, as per Ind AS 14, we need to give fair value. We need to give fair value disclosures. We will not measure it at fair value. We need to give fair value disclosures. So the fair value disclosures, for that they have done some fair valuation and they have given some inputs. Now it may not be possible for us to remember everything for disclosure purposes in the examination, but at least we can do as much as we can. First is schedule of the asset in the balance sheet, opening amount, addition, closing amount, depreciation, opening, addition, closing amount. This is done. Okay, this will give you 2 marks. Then disclosure requirement for items recognized in P&L, rental income, what is recognized, direct operating expenses with the detailed breakup, net investment before depreciation, net profit before depreciation, net profit after depreciation. Can we do this? Yes. Then disclosures. What are the what all we need to disclose? So you can give the disclosures. This we can't learn. We can't learn by heart. So describe the property. The investment consists of property A and property B. Property A is for this purpose, property B is for that purpose. How did we get to the fair value? Independent valuers. What is the method adopted? Recommended method is adopted. What are the factors? Management intention terms, etc. we have considered. Then this observable inputs and the range. Okay. It may not be 100% correct. See, these kind of questions, we can't say that we'll be able to do 8 out of 8. But can we do at least 5 out of 8 or 6 out of 8? Something where we don't need to waste a lot of time in calculating and computing. Okay, so you should definitely consider this. Then this illustration you can do it subsequently on your own as well. Classification. Now for the purpose of classification, one rule that you have to keep in mind is, if significant portion is let out, if it cannot be divided and significant portion is let out, it is investment property. For example, if there are 10 floors, in 10 floors, if I have let out 2 floors, 2 floors will be investment, 8 will be PPE. If I have let out 9 floors, 9 will be investment, 1 will be PPE. But if it is not different floors, it is a single floor and 80% is let out, so that entire floor will be considered as investment property. If 80% is self-use, then in that case we will say that it is a property, plant and equipment. Sir, how to decide? You have to say whether can I separately give out that asset on a finance lease, or can I separately sell off that asset? Then it is separable. Otherwise it is not separable. Then if I have given flats to my employees for their residence, even if I collect rent, that will be part of property, plant and equipment, because that will be related to my operating activity. Okay, so that is one thing you can consider from here. In this, apart from this, there is nothing great to look at it. Okay, then I hope you are being able to follow. If there are any questions, please note it. Yes, as I told earlier, the video will be available. I will not be removing the video, so you can have a look at the video whenever your time permits. That will be more than important, useful. Okay, then coming to borrowing cost. Now borrowing cost in a way is a straightforward and easy standard. There are 2-3 things you have to keep in mind. One, you have to follow the effective interest rate for your liabilities. as per Ind AS 109. This is first thing. Second thing, general and specific. Specific, you will always take full interest minus temporary investment income. General, you will consider weighted average rate and you will multiply it with the number of months and do the calculation. Okay, if you have understood this, the standard is covered. And yes, there is one more aspect of where, if at all there are exchange differences, if there are exchange differences recognized as loss to the extent of interest savings, this will be considered as borrowing cost. Okay, so this is one more thing you have to keep in mind. Beta had following loans in place as on 31st March: 18% term loan, opening closing, 14% debenture. 14% debenture used to construct office building on 1st of July, but the development is yet to start. If it is specifically to fund the construction, then in that case this will not consider. This is a specific borrowing, will not consider. On 1st of April, why we will not consider? See, you may say, sir, just now you said specific borrowing, take it from the date of borrowing. Yes, but activities must have started. If activities have not yet started, if expenditure have not been incurred, then what happens? Then in that case we can say that the active development is not happening. If active development is not happening, we cannot capitalize. So that is where we are excluding this. Beta Limited began the construction of a plant being qualifying asset using the existing borrowing. Expenditure drawn down for the construction was 5 lakh on 1st April, 25 lakhs on 1st of January. Calculate the borrowing cost. Now here, this is specific, you will exclude. 18 and 16, you will calculate something called as the capitalization rate. How to do that? Take the total interest divided by the total borrowings, you will get the capitalization rate. Now, if borrowings have been made mid-year, then you will follow the weighted average concept or number of months concept or product concept to calculate the weighted average borrowing. Then 16.5, 1st April expenditure 12 months, 1st January 3 months, you will calculate the interest expenditure. Let's look at this one. Entity constructs new head office building commencing on 1st of September, which continues till 31st December. Attributable expenditure at the beginning of the month for the asset is 1 lakh in September, 250 in October to December. Entity has not taken any specific borrowing but has incurred finance costs on its general borrowing during the construction period. The entity has issued 10% debentures with a face value of 20 lakhs and has an overdraft of 5 lakhs, which increased to 750 on December 1st. Interest was paid 15% till 1st of October, then 16%. Now here in this question, there are multiple borrowings. First is 10% debentures, okay, 20 lakhs. Bank owed you 15% 5 lakhs, subsequently it became 16% 5 lakhs, another 7.5 lakhs. Now these are happening at different part of the month. Now here, in this case, they have not said whether the debenture are outstanding from the beginning or they have issued on 1st of September. Accordingly, your answer will change. Logically speaking, because we'll take for the full period, all the capitalization rate calculations and all as per Ind AS 23 has to be done considering full period. It is not for the construction period. Okay, per definition only this is how it has to be done. And ICAI also, in some RTPP they have taken 12 months, some places they have taken from 1st of September. Okay, but this is the logical approach. So 10% debentures 20, number of months is 12. So what are we doing? Whenever we have in between borrowings, we are calculating what is the equated monthly borrowing. What is the equated monthly borrowing? Okay, so 10% debentures 240 per month. If it is 20 for the year, 240 for month. 5 into 9, 45, 10, 7.5. Total borrowing is 302.5 and interest is 2.7958. So this, if you see, 2.7958 divided by 302.5, what you get into 12, you get 11.09%. Okay, I think I missed to answer Aryaman's question earlier. How much theory it is right? So theory depends on what the question has asked. Calculate, if the question says calculate, do the calculation, give brief explanation if required. In questions where financial instruments are there, in questions where business combination questions are there, don't write too much of theory. Don't write one page, 1.5 page theory. I have seen students writing 1 page, 1.5 page theory and not getting marks. Okay, so that is how you have to do. But if the question says advise, analyze, explain, describe and all of that, there you will have to include theory as well. Okay, so I hope this part is clear. This will help you to compute the capitalization rate whenever you have to. Marine Transport Limited ordered 3 ships for its fleet on 1st of April. It pays a down payment of 25% of the contract value out of long-term borrowing from a scheduled bank. Delivery has to commence from year 7. On March, the shipbuilder informs that it has commenced the production of 1 ship. There is no progress on other 2 ships. They prepare the financial statement on financial year basis. Can they capitalize borrowing cost for this? Now, generally, trucks, machines and all, we say when we buy, they are ready for use. But here, we are giving an advance and it takes substantial period of time to get ready for use. So, to the extent where the work has started, for that ship, we can capitalize. Otherwise, we cannot capitalize. So, borrowing cost related to other 2 ships prior to commencement will be expense. Sir, but we are not doing the construction. No, it doesn't matter. Does the asset take substantial period of time to get ready? That is the question. K Limited constructed a new building at a cost of 7 lakhs on 1st of April. To finance the construction include specific loan of 2 lakhs from a financial institution at a rate of 9%, and these are the general. For the general borrowings, what you will do? You will calculate the capitalization rate. Expenditure, now 1st April 1 lakh 50. So we will assume 1 lakh 50,000 is from specific borrowing. Then 2 lakhs. Here 50,000 will assume is from specific borrowing and 1,50,000 is from general borrowing. This is general borrowing, this is general borrowing. Now wherever there is a specific borrowing, you will take 9% as the rate. You will take 9% as the rate and do the calculation. Okay. The construction was completed by 31st of January. So 31st of January, accordingly you will do the calculation. So 50 into 9% into 10 divided by 12. So here it is 10 months for this specific borrowing. Okay, 10 months here, 10 months here for specific borrowing. For general borrowing, number of months, and accordingly get to the total cost. Same thing here, this you can put it for self-practice. Similar concept that we have discussed earlier. See, once you are able to calculate the capitalization rate and apply the principle, okay, specific separately, fully and general for respective months, and income if at all is any there, you have to reduce it. This is one more case where, which is related to group of companies. In a group with parent company P, there are 3 subsidiaries: real estate company, construction company, finance company. Parent company has no operating activities but performs management function. Finance and activities and cash management are coordinated centrally. So it is done centrally at the group level. Finance company is a vehicle used solely for raising finance. So this is only for raising finance. All entities prepare Ind AS financial statement. Following information is relevant. Real estate company, borrowing of 10 lakh with an interest of 7%. Expenditure on qualifying asset during the period amounted to 1540. All construction works are performed by construction company. Amounts invoiced to real estate company include 10% profit margin. Okay. Now, in the standalone financial statement of real estate company, what happens is you have to see how much did they borrow? 10 lakhs. Expenditure 1540. So for them, the cost is 1540. See, for the group there may be a profit element, but for this party it is 1540 only. That is the cost. But my borrowing is only 10 lakh. So 10 lakh into 7%, I can capitalize only 70,000 for real estate company. Finance company, they are not constructing or acquiring any qualifying asset, so they will not have anything. Construction company, no borrowings. No borrowings means no qualifying, no borrowing cost to be capitalized. Okay. Finance company, nothing. Now, when it comes to parent company, how do we do? So what you have to do is, in case of parent company, you have to treat entire thing as a group, and you have to see that yes, this group has general borrowings. If there is specific borrowing, well and good. Other borrowings, you can pool all of them together as general borrowings, because they are saying centrally they are being managed. Okay. So for the parent company, The borrowings is how much? Real estate company 10 lakhs, finance company 20 lakhs. This is the total borrowing. What is the expenditure? Expenditure is here, expenditure on qualifying asset 15,40,000 by that particular real estate, which company was there, sorry, real estate company. Construction were performed by the construction company. Expenditure on qualifying asset is 15,40,000. That is one. Then real estate company expenditure on qualifying asset is 14 lakhs. Why? 1540 includes profit element. Construction company has a cost of 10 lakhs. That is the total cost. And what are the interest expenditure? 10 lakhs and 20 lakhs. This is the total interest. And accordingly, you will calculate the borrowing cost to be capitalized and balance will be expensed. This one, follow the effective interest rate and accordingly calculate the IRR. They will not ask you to calculate IRR in the examination. Okay, so you can follow the Ind AS 109 principle and get it done. Another question here, LT is in the process of constructing a building. The construction process is expected to take about 18 months from 1st of January till 30th of June. Building meets the definition of qualifying asset. They incur the following expenditure: 1st January, 30th June, 31st March and 30th of June. These are the expenditure. On 1st of July, LT issued 10% redeemable debentures of 50 crores. Proceeds from the debentures are part of general borrowing which is used to finance the construction of the asset. They had no borrowing before 1st of July. Now here, 1st of January they have started incurring expenditure. Now in this question, specific thing you have to keep in mind is 1st of January expenditure has started. Borrowing happened on 1st of July. So from 1st of January till 1st of July, there is no cost or no borrowing cost to be capitalized. This is understood. But then when I start capitalizing cost from 1st of July, should I only consider subsequent expenditure or previous expenditure also? I have to consider previous expenditure also, because if previous expenditure were not there, borrowing cost would not have been incurred. So I have to consider this 25 crores here. That is the only tricky part in this question. And on that 25 crores, I have to start charging, capitalizing borrowing cost from 1st of July. That's the first thing. Second thing is, when I go to the next year I have to take previous year cost plus interest, and on that amount I have to charge the depreciation, or I have to compute, I have to compute the borrowing cost. So what I mean is, first year no borrowing cost, second year I will take previous year expenditure also, previous period expenditure also, and calculate the borrowing cost. Then in the third year, what happens is, I will take interest of the previous year, and on that also I will charge the interest amount and calculate the borrowing cost. This one is where there are phases. Okay, now whenever there are phases, you have to see, can I use one phase independently? If I can use one of the phases independently, once the asset is ready for use, till that date interest will only be capitalized. So here phase 1 and phase 2 will be started as soon as they are completed. So phase 1 and phase 2, whatever is the cost, we will stop capitalization once they are ready, and on the remaining phases we will continue to capitalize. So cash expenditure, building purchase, total expenditure is given. Total expenditure is 221. Loan taken 15% for 200. So 200 loan that has been taken is for 221 expenditure. So capitalization will also be based on what is the total expenditure out of 221. Accordingly, proportionately only we will capitalize. During the mid-year, phase 1 and phase 2 have become operational. Find out the amount to be capitalized. So 200 is the loan, 200 into 15%, how much we get? 30 lakhs. This 30 lakhs has to be allocated based on the expenditure totally. Then phase 1 and phase 2 have to split, 50% capitalized, 50% expense. Why? Because mid-year they have been completed. So 461 by 2 will be capitalized, 461 by 2 will be expensed. Similarly, for 2, 868 by 2 capitalized, balance will be expensed. 3 and 4, full amount will be capitalized. Then there was this question on RTP. Pretty interesting question, to be frank. Here the thing that you have to keep in mind is that should we do it on accrual basis or cash outflow basis? So after a lot of deliberation and discussion, they have given a conclusion that it has to be based on cash outflow basis, because I will incur expenditure when there is a cash outflow. I will incur borrowing cost when there is a cash outflow. If there is no cash outflow, I will not incur any borrowing cost. So it has to be based on borrowing cost. It has to be based on actual cash paid. So based on the actual cash paid, I will compute the interest. I'll compute the interest based on actual cash outflow, and accordingly we will do the calculations. Okay. So far we have completed a quick recap including important theory of 2, 16, 38, 40 and 23. We will take a quick, I'll take a 10 minutes break. I need some rest for my throat, and we will continue with 20, 36 and all of these standards. Try to complete these by lunch, and post lunch we'll cover the balance standards. So I didn't realize the timer would stop in between. Anyways, okay, so I'm just pausing this timer and let us start. Okay, share this question. Yeah, what I'll do is not only this, the remaining questions also, I'll compile it as maybe a single file and then upload it in our resources section. I hope the speed has been good and it has been helpful so far. Okay, if you have anything or any feedback, do let me know. Accordingly, we'll improvise. Okay, the idea is to give you a very quick glimpse of what you have to do for the examination. Now moving on to the next one, which is Ind AS 20 on government grants. So Ind AS 20 on government grants, a very simple and straightforward standard. There is nothing complicated in this standard, but few things you have to keep in mind. Exclusions: government participation in ownership of the entity, that is one thing. Government grants, that is covered by Ind AS 41, that is the second thing. Then sales tax exemption is covered, that means GST exemption will also be covered. Income tax exemption will not be covered. Okay, now how to deal or how to handle government grants? Grant related to assets, what you can do, there are two choices: reduce from the cost of asset or recognize deferred grant and transfer to the P&L in the ratio of depreciation. If it is related to income or expense, we will have deferred grant accounting only and transfer it in the ratio of expenses. If it is non-monetary grant, recognize the grant either at fair value, recognize the asset at fair value and grant at same fair value, or recognize them at nominal value. Okay, so these are the three things. Then if it is related to loan is a case where government says, okay, market rate is 10%, I am giving you at 8%. Then that component of discount that you get, that we'll do the fair value of the loan considering 10%, and extra amount is considered to be government grant. Repayment of government grant, again very simple, just reverse the original treatment. If you have reduced from the cost of asset, add it to the cost of asset. If you have recorded as deferred income, whatever is the balance in the deferred income, you will debit that. If balance in deferred income is not sufficient, then you will debit it to the P&L. Now here, one very important thing which a lot of students may have forgotten also by now: depreciation will be retrospectively calculated and any shortfall in depreciation will be charged immediately. This is one thing you may have forgotten. I'm not saying you have forgotten, you might have forgotten. So if at all there is any shortfall in depreciation, that shortfall in depreciation should be computed and charged immediately to the P&L. Alright, now let's look at the questions. The first one is related to a loan. A Limited received from the government loan of 50,000, 5% payable after 5 years in a bulleted payment. Bulleted means single payment, like a bullet. The prevailing market rate of interest is 12%. So what we will do, whatever is the payable amount, cash flow, we will discount at 12%. Interest is payable at the end of each year. How much will they pay? Not 12%, they will pay only 5%. So like we calculate the present value of bonds in when we do Ind AS 10, right? Same concept here. 50 lakhs into 5%, every year interest is 2 lakh 50, fifth year repayment is 50 lakhs. Now this you can do two ways: 2 lakh 50,000 into present value annuity factor plus 50 lakhs into present value factor. The fair value of the loan comes to 37 lakhs 38,000. Fair value of the loan comes to 37 lakhs 38,000. What is the loan amount? 50 lakhs. Loan amount is 50 lakhs. So the difference is treated as government grant. This will be treated as deferred government grant and transferred to P&L systematically over a period of time. Okay. Now entry: bank account debit, government grant and finance liability. How the grant will be recognized in the statement of P&L, assuming loan is an immediate relief measure to rescue the enterprise. See, if it is an immediate relief measure, there are no future conditions. There are no future conditions attached. So immediately you can recognize in P&L. If it is a subsidy for staff training expense incurred equally for a period of 4 years, every year you will divide this by 4 and you will record the. You have to allow me a minute. I think that I forgot to put this pencil on charge. Give me a minute. Okay. Then the third scenario what they have said is that the loan is to finance a depreciable asset. If it is to finance a depreciable asset, what do? We will reduce it from the cost of asset, or we will set it up as a deferred government grant. Continuing to the next question. ABC Limited is a government company and is a first time adopter of Ind AS as per previous GAAP, means accounting standard 12. Contribution from ABC, which holds 100% shareholding in the nature of promoter's contribution, was recognized in capital reserve. Now in AS 12 we had this concept that grant in the nature of promoter's contribution should be recognized in capital reserve. But in Ind AS there is no such concept. All the grants directly or indirectly will be routed through P&L, either by reducing the depreciation impact or by creating a deferred grant account. State whether the accounting treatment of the nature in promoter's contribution is also permitted. No, it is not permitted. So what you have to do? You have to do a retrospective application. An entity opens a new factory and receives a grant of 15,000 in respect of capital equipment costing 1 lakh. It depreciates everything on 20%. Show the statement of P&L and balance sheet for the grant under both the methods. So very simple. If it is reducing the thing 15,000, you will reduce it from the cost 85,000. On this you will charge depreciation. Whereas if it is set up as a deferred government grant, then what would you do? In that case, what you would do, you would calculate depreciation on this amount, and in the ratio of depreciation you will transfer to P&L. Now here please understand, SLM basis is given, so government grant also will transfer to P&L on SLM basis. So what if WDV is given? There is a shortcut to calculate. Let us say WDV 20% is followed. Okay, so 15,000. First year you will say 15,000 into 20%, this will become 3,000. Second year you can do 3,000 into 80%, that is 2,400 for quick calculation. Third year 2,400 into 80%, and like that you can continue. This is one illustration which the this is the one, yeah, this is the one. ICAI has changed the solution 3 times. Okay, first two were illogical. Right now what they have done is by and large logical. Okay, so this is a changed solution. You can have a look at the May 25 material. May 25 they first updated half, and then later again they changed that, and the thing is they don't announce also. Entity A is awarded a grant of 60,000 receivable over 3 years, 40,000 in year 1, 10,000 each in year 2, year 3, contingent on creating 10 new jobs. The employees are recruited at a cost of 30,000 and the wage bill for the first year is 1 lakh, rising by 10,000 in the subsequent year. Now grant is how much? 60,000. You have to allocate it in the ratio of expenditure of first year 30,000 and 1 lakh, 1 lakh 30,000. Second year 1 lakh 10,000, because 1 lakh is the wage bill by 10,000. Third year 1 lakh 20,000. Calculate the grant to be accounted if there is a reasonable assurance that the entity will comply with the condition and the grant would be received. In the first case, it is straightforward. If you comply with the condition, entire 60,000 can be recognized as grant receivable, and 40,000 you have received in first year, 10,000 each you will receive in the second and the third year. Okay. Then, second, if there is no assurance that the grant would be received, now, if there is no assurance that the grant would be received, then only to the extent we have received the grant, we can recognize the government grant. So, what we will do in that case? We have received 40,000 in year 1. So, year 1 accounting we will do considering 40,000. This will be recognized over 3 years in the ratio of 130, 110 and 120. Second, 10,000 received in second year. It will be recognized as income in second year and third year. Third, 10,000 received here will be recognized only in the third year. Okay, so here we have split the government grant received in each of the year. This is more a logical solution, and they have also made a small tweak in the question which makes the solution logical. Alright, then refund of grant. Now in refund of grant, always remember, if you have reduced from the cost, you will add to cost. If you have deferred income, what will you do? You will debit the deferred income balance, and if something is shortfall, if there is no sufficient balance in the deferred income account, then in that case what you will do, you will debit it to P&L. Simple and straightforward. Okay, so X Limited grant related to 5 lakhs, transferred 1 lakh to the statement of P&L in 1 and 2, so balance is how much? 3 lakhs. If total grant is repaid, you will debit 3 lakhs in the deferred government grant account and debit P&L by 2 lakhs. If 2 lakhs is repaid, you will debit that 2 lakhs in the deferred government grant account only. So look at this question. A Limited has received a grant of 10 crores in the year 1-2 from local government in the form of subsidy for selling goods at lower price. Okay. A Limited had accounted for the grant. While accounting, they were assured that conditions will be complied. However, in year 5-6, it was found they have not complied with the condition. Now the grant has become fully repayable. How should A reflect the repayable grant in the financial statements? Okay. So here, this they have received and they are accounted for grant as income in year 1, year 2. Now if you refund, what happens? When you refund, you have to debit in the P&L. So this is similar to what we had done earlier, this question. A Limited is engaged in manufacturing of certain specified chemicals. Now see, if you look at the question, no, you will feel, array, such a long question, will we be able to handle it? Have patience. Generally, my experience has been longer questions are easier to solve. Okay. Engaged in manufacturing of specialized chemicals. During the manufacturing process, certain wastewater is produced which is released by A in the nearby river. To reduce the pollution, the state government has introduced a scheme with the following features. If the manufacturer installs certain pre-approved wastewater treatment plant, government will provide an interest-free loan equal to 50% of the cost of the plant. So whatever is the cost of the plant, you will provide interest-free loan. Means they have given interest-free loan. So what do? We will take the market rate and will discount the interest-free loan and calculate what is the fair value. Such loan will be repayable to the government in 5 years from the date of dispersal. 5 years is the period. Manufacturer availing the benefit of this scheme must treat the wastewater of its factory using the plant before releasing it to the river. If this condition is violated, the entire loan becomes immediately repayable to the government along with a penalty of 10 lakhs. So here, not only the loan, even penalty has to be paid. Cost of the water treatment plant is 50 lakhs. So how much loan will we get? We will get a loan of 25 lakhs. So first thing what I have to do is that 25 lakhs, this 25 lakhs, what is the present value? Now please remember, there is no interest. There is no interest. So only 25 lakhs at 12% if you discount, 25 lakhs divided by 1.12. 25 lakhs divided by 1.12. 1 divided by 1.12. 1, 2, 3, 4, 5. So when you do the total, you get 3.60. Sorry, fifth year only, no? I did annuity by mistake, okay? In the calculation. We need present value of single cash flow. So 1 divided by 1.12, 1, 2, 3, 4, 5. We get 0.567. 0.567 into 25 lakhs. We get 1417. So this is the loan, balance is government grant. Loan will be treated as a liability, as a financial liability as per Ind AS 109, and the government grant, the difference will be taken to deferred government grant account. So the first entry will be this. Okay, then A Limited decided to utilize this scheme because if it were to obtain a similar loan, it would have paid interest of 12%. Accordingly, they applied and A Limited purchased the machine. Okay, A Limited has an accounting policy of recognizing government grant in related to depreciable asset in the proportion of depreciation expense. So on SLM basis, it has determined that it is SLM basis. In the month of March, government official conducted an audit and it was found they had not been using the treatment plant, and on 31st March of year 3, they ordered to repay the entire loan with the penalty. Now, when did they take? 1st of April of year 1. When are they refunding? After 2 years. So we have to prepare the loan account for 2 years. So if you prepare the loan account for 2 years, the closing balance is 17,78,000. Now please understand, this loan amount of 17,78,000 is one thing. You have to repay fully 25 lakhs. That's the first thing. Second thing, you also need to pay a penalty of 10 lakhs. So total payment is how much? Total payment is your 35 lakhs. Total payment is your 35 lakhs. So how do we account for it? See, you can say I have repaid the loan of 17,78,000. I have repaid the loan of 17,78,000. That is the value of loan in my books. Okay. Then whatever is the closing balance of government grant, 6,49,000, this also needs to be debited. So we will debit that as well. And we have paid 25 lakhs. The difference of 72,000 will be considered as an expense in the P&L apart from 10 lakhs of the penalty that is paid. Not only that, this 10 lakhs and this has to be paid, and there will be no balance in deferred grant account. Okay, that is one thing you have to keep in mind. Not only that, if you want, you can split this entry. You can say loan account is settled by paying 17,78,000 and balance amount is like my refund of the grant. That also can be done. Then measure the government grant on 1st of April, determine the nature of government grant and its accounting treatment for the year ended 31st March. Also determine the impact of P&L on account of revocation of government grant. So whenever the grant is revoked, whatever is the impact that we have computed. Now in the same case, if I have given an alternative treatment, if the grant is reduced from the cost of the asset, then how should the treatment be done? Then you will take the cost less government grant, net amount. On this you will charge depreciation, carrying amount. Refund of the grant you will add back and you will have the revised carrying amount. You also need to calculate what is the shortfall in depreciation for 2 years. Means you would have calculated actually 20 lakhs, but you have calculated only 15 lakhs 67. This depreciation should also be charged. So when you look at this, the amount of entries will match with the entries that we have seen in the previous case. So here, if there is shortfall in depreciation, then that shortfall will also be charged to the extent of 4,33,000. Loan account fully refunded. The balance amount refunded will be debited to the plant account and you will credit that amount to the bank account. Now how did you get 1082,500 refund of grant? See, apart from the loan, so there is loan, then there is an impact to the P&L, the balancing figure will be added to the plant. Okay. Now moving on to the impairment of assets. As far as impairment of assets are concerned, only thing you have to be careful about is what is the present value of cash flow, which is considered to be value in use, and what is the fair value less cost to sell. This will give you the higher of these two will give you the recoverable amount. Okay. Now this recoverable amount will compare with carrying amount. If recoverable amount is less, then there is impairment. Now there are three types of questions that you will encounter. Number one is your calculation of impairment. Number two is reversal of impairment, and in reversal of impairment one specific calculation is maximum amount of reversal. How much should be the maximum amount of reversal? That is where a lot of students make mistake. And then we have one related to goodwill. We have one related to goodwill. Again, I'll need a minute. I'll again resume. So three type of questions that I was mentioning. First, calculation of impairment. This most of the students can do. Reversal, a lot of students get confused between maximum amount that can be reversed. So that is the second thing. Third thing that you have to do is with respect to goodwill, especially the grossing up part. Okay, then whenever there is goodwill related to let's say CGU, that is one part, or there are multiple assets in a CGU, first you will write off goodwill impairment, then you will write off impairment of other assets, that we know. But there are some assets like inventory, trade receivables, which are measured as per other standards. There you will not do impairment as per Ind AS 36. There impairment will be done or losses will be booked as per the respective standard. Alright. So let us look at the first one. Mars Limited gives the following estimates of cash flows relating to property, plant and equipment on 31st of March. Discount rate is 15%. PPE was purchased on 1st of April of 20 lakhs. Useful life is 8 years. Residual value is 500 lakhs. Same number here. Fair value less cost to disposal is 10,000 lakhs. Calculate the impairment loss on PPE and calculate the revised amount and revised depreciation. How to calculate? First, calculate the present value of this. Present value of this comes to 9510. This, I think, given the number of questions you have done in FR and largely in AFM, you should be able to do this directly. 9510. Okay. Here, only thing is residual value should also be considered. Then, fair value less cost to disposal is how much? Fair value less cost to disposal is 10,000. Higher is 10,000. So, 10,000 becomes the recoverable amount. What is the carrying amount? Purchase for 20,000. 20,000 minus 500, 19,500. Depreciation for 3 years is 7,312. What is the carrying amount? A lot of times students, when they are in a hurry, they will do 19,500 minus 7,312. No, you have to do 20,000 minus 7,312, 12,687. So, how much is the impairment? Impairment is 22687. Okay, that is the impairment. And based on that, revised depreciation is 1,900. Simple. If there are foreign currency cash flows, what is to be done? Take the discount rate which is applicable to the currency and convert it using the closing rate. So, if you have to calculate on, let us say, 31st March of year 1, you will take 10% and then use 45 to convert. Means cash flows will be discounted using US rate, and using the closing rate we will arrive at the present value of cash flows. From the following, calculate impairment loss, current year depreciation for the year. Cost is so much, useful life is so much, carrying value at the beginning is 27.3. Remaining useful life is 3, recoverable amount is 12, upward valuation done last year 14 lakhs. Now, whenever an asset has been subject to revaluation model, impairment loss is treated as a change in revaluation. Okay, so carrying amount is 27, recoverable amount is 12. So, how much is the loss? 27 minus 12, 27.3 minus 12, 15.3. Okay, so what we will do? In that case, first you will adjust the revaluation surplus of 14 lakhs and balance 1.3 lakhs will be recognized as an expense. Simple. This you can practice on your own. Similar concept again. Revaluation, whenever revaluation is happening, you will treat the changes in impairment as changes to revaluation. The course of utilization of machine, the company did not opt to transfer part of revaluation surplus. So let me do only, so that you get a good thing of how it is done. On 1st January, entity Q purchased a machine costing 2,40,000 with an estimated useful life of 20 years and 0 residual value. So depreciation is how much? 24 by 20. 24 by 20, it is 12,000. Yeah. Depreciation is computed on SLM basis. Asset has been revalued on 1st of January to 250 when year 3. Now, when they say 1st of January, first calculate till 31st of December. Amount is 216. Fair value is how much? 250. So, now the carrying amount becomes 250. This 34,000 becomes revaluation surplus. Now, from year 3 onwards, you will consider 250 to calculate the depreciation. 250 divided by remaining useful life 18 years, 13,388, and carrying amount is 236. Okay. On 1st January, an impairment review showed machine's recoverable amount to be 1 lakh and its estimated remaining useful life to be 10 years. Now, what happened? Here we did 236. Then, immediately on the next year, first day of the next year, they got recoverable amount to be 1 lakh. So, 136 is the impairment loss. This impairment loss will be set off against this revaluation surplus of 34,000, and balance. And balance, how much is balance? 136 minus 34, 102. 102 balance, this is 136. 102 will be recognized as an expense in the P&L. They have not transferred anything to the retained earnings, so entire revaluation surplus can be used. Sir, what if they had transferred? Then 34,000 divided by 18, you transfer 1888.88, and the amount that is left is 32,111.11. So in that case, only this much can be used. Balance has to be debited to P&L. All right. PQR Limited is the company which has performed well in the past, but one of its major asset, an item of equipment, suffered significant and unexpected deterioration. They expect to use the machine for a further 4 years after 31st March, but at a reduced level. The equipment will be scrapped after 4 years. Financial accountant has produced a set of cash flow projection for the next 4 years. CFO thought the projection were too conservative and he intended to use the highest figure. So these are the fews. The above cash flow should be assumed to occur on the last day of each year. Okay. The pre-tax discount rate is 9% and the machine could have been sold on 31st March of year 6 for 6 lakhs and related selling expense would be 96. Machine had been previously revalued and amount of 36,000 was held in revaluation surplus. Now here the 6 lakhs minus 96,000 is what? Is my fair value less cost to sell. The carrying value of the asset on 31st March year 6 was 6,60,000. We are doing it on 6th that date. The Indian government has indicated it may compensate the company for any loss in value of the asset up to its recoverable amount. Calculate the impairment loss. Also suggest how impairment loss, if any, would be set off and compensation from the government. So first is, what is the value in use? Value in use is, you take the 4-year cash flows, 588, 230. Okay. Then equipment will be scrapped, so there is no sale value. So this is the present value or value in use. Then what is the fair value less cost to dispose? 96, not 96, 504. Fair value less cost to dispose is 504. Higher of the two, 588. Carrying amount 660. Impairment loss 71,769. Then impairment revaluation surplus is a balance of 36,000. So what you will do? Out of the 71,769, 36,000 you will set off against revaluation surplus and balance will be recognized as an expense in the P&L and subsequent depreciation will be like this. Now here, see, what is the question? Calculate impairment loss and revise depreciation. Also suggest. So the moment they say suggest how the impairment loss would be set off and compensation from the government would be accounted for, that you have to give a descriptive answer. Compensation from the government is what? It's a government grant. So it will be dealt with as per government grant. Sorry. This is one comprehensive illustration which covers almost all the aspects of impairment. Okay, so you have a CGU, plant and machinery, building, electric equipment, goodwill, patents, other monetary assets total, and the recoverable amount is 2 lakhs. So how much is the impairment? Impairment is 1,50,000. Now few things. This impairment, first you have to write it off against goodwill. So goodwill will be impaired fully 50,000. Second thing, remaining you will do in the ratio of their carrying amount. But here are some exceptions. Number one, if there are some monetary assets which generally are valued as per Ind AS 109, for example, account receivable, Ind AS 109. So you will consider as per Ind AS 109 principles. Okay. Then building has 80,000 of carrying amount, fair value less cost of disposal 85,000. Building is not impaired. So I cannot impair the building. So impairment will not be there. So what are left? 1 lakh, electric equipment, patents. Amongst these three, we will do the allocation. So you will allocate the loss between first goodwill, then remaining 3 assets. That is how you have to do. Then we have concepts where there are corporate assets. Now, as far as corporate assets are concerned, these are assets related to, let us say, head office or centralized IT services, centralized HR services. Okay. So, whenever we have these corporate assets, what we need to do is we need to allocate them on a reasonable basis to the CGU. What are CGU? Cash generating units are group of assets which generate cash flows independent of other group of assets, right? For example, let's say hotel division. Okay. Whenever we do impairment, first we start from the lowest level of unit possible. First we will take individual asset. If individual asset does not generate sufficient cash flow, then we'll aggregate some assets and move to a CGU. Whenever we are doing an impairment of CGU, we also need to allocate goodwill and corporate assets. Now here, if corporate asset can be allocated, then we'll allocate to the carrying amount of the assets. If they cannot be allocated, then what we will do? First we will test CGU for impairment independently. Then we'll take the CGU plus corporate asset and then do the impairment testing again. Okay, so ABC has two corporate assets having a remaining useful life of 20 years. Corporate asset X, corporate asset Y, 600, 200. Carrying amount of X can be allocated on a reasonable basis to the individual CGU. So we can do this. Carrying amount of Y cannot be allocated. Okay. Now how do I allocate? 600 is there. Don't directly do it like this because useful life is different. When useful life is different, then we'll calculate weighted average useful life. The reason is A will use the corporate asset only for 10 years. So equivalent value per year is 500 into 10, 5,000. 750 into 20, 15,000. So you have to calculate on a product basis. How much is the carrying amount multiplied by the life. So carrying amount multiplied by the life, you will get these bits. So 500 into 10, you can do 5,000, or 1:2:2, that also you can do. Pro rata allocation of X. How will I do the pro rata allocation of X? 500 divided by 4,200 into 600. So we get 72, 216 and 312. This is the allocation. Carrying amount after allocation 572, 966 and 1412. Alright. Now, once this is done, the next step is compare that with the recoverable amount. So the recoverable amount has been given in the question. 600, 900, 1400, and for the company as a whole 3200. 600, 900, 1400. Now the problem in this question is they have said ignore decimals and they have rounded off decimals. So when you say ignore decimal, 71.42 should be 71, but they mean actually round off. Okay, so I don't know when will they improve this, giving instructions clearly in the question so that the students are not confused. So so 572 versus 600, is this impaired? Not impaired. 966, 900 impaired? Yes, 66. 1412, 1400 impaired? Yes, 12. Now this impairment of 66, what we will do? We will have to allocate to whom? To B. Now B has what? 900 of CGU plus corporate asset is also there. So what we will do? Whatever is the impairment loss of 66, we will allocate to the corporate asset and other asset. Okay. How? In the ratio of their carrying amount. What is the ratio of carrying amount? See, this 966 has 216 of the carrying amount of X and 750 of other carrying amount. So 66 into 216 by 966, 15 goes to B, X, and 51 goes to other assets. Similarly, for this 12, 3 goes to corporate asset X and 9 goes to other assets of C. So once this is done, because we could not allocate Y, what do? We do the subsequent impairment testing by taking Y as a whole to A, B and C. So after allocation of impairment, what is the carrying amount? A is 750 as it is, no change. Sorry, 500 as it is. B is 750 minus 51, so 699. C is 1100 minus 9, 1091. X is 600 minus 18, 15 plus 3, 582, and Y is 200. We'll do the total of this, we get 3072. Recoverable amount is 3200, there is no impairment loss. Okay. This is one question which you should definitely have a look at it before the examination, because these questions, this specific question has not been tested for a long time. This just involves normal forecasting. How do you forecast the cash flows? You can have a look at it. Then now moving on to business acquisition or business combination, you can say. Now as far as business combination cases are concerned, the thing that you have to keep in mind is there is goodwill. Goodwill cannot be amortized. Goodwill has to be tested for impairment. Now Ind AS 103 tells us that whatever is the fair value of net asset applied, net asset acquired, you compare this with your purchase consideration plus NCI fair valuation. If the fair value of net asset is less and what you have paid is more, there is goodwill. And whenever there is goodwill, you have to test goodwill for impairment. Now, as per Ind AS 103, NCI can be tested or can be valued using either fair value method or proportionate share in net asset method. If it is done using fair value method, we say that this goodwill is full goodwill. F. P means this is part goodwill. P. Okay. If it is fair value method and full goodwill, there is no complication. But if it is part goodwill, then because the recoverable amount of the subsidiary is considered for 100%, the part goodwill has to be grossed up. So what we'll do, whatever is the goodwill, part goodwill recognized, we'll gross up to bring it to 100%. Okay. So let's look at this question. Here it is 100% acquisition. Venus Limited acquired 100% of Saturn Limited for 4 lakhs. Fair value of net identifiable asset was 3,20,000 and goodwill was 80,000. Simple. Saturn is in coal mining business. On 31st March, the government has cancelled licenses given to few states. As a result, the revenue is estimated to reduce by 30%. Adverse change in marketplace and condition is an indicator of impairment. As a result, Venus has estimated recoverable amount of goodwill and net asset of Saturn Limited on 31st of March. They use SLM method of depreciation. Useful life of Saturn Limited asset is estimated to be 20 years with no residual value. No independent cash flows can be identified to any individual asset. So entire operation of Saturn is treated as a CGU. The entire group, the entire subsidiary is treated as a CGU. Suppose by 31st March government, it is not possible to determine the selling price of Saturn Limited. Its value in use is estimated by management at 212,000. So this is the value in use. Suppose by 31st March government reinstates the license of Saturn Limited. The management expects a favorable change. There is an indicator that the impairment is reversed. Recoverable amount of Saturn Limited net asset is re-estimated. The value in use is expected to be 304 and fair value less cost to dispose is 290. Now here, calculate the impairment loss and reversal. First thing, calculation of impairment. Okay. As far as calculation of impairment is concerned, now in this case what you have to understand is they purchased on 1st of April. Net identifiable asset was 320 and goodwill is 80,000. Venus Limited uses SLM depreciation. Useful life of asset is estimated to be 20 years. Okay. So in this case, what you have to keep in mind is, first, I have to calculate the carrying amount of other assets. 320 minus 32, 288. Okay. You have to calculate carrying amount of other asset. Then, once I get the total value, now how will I get the total value? Goodwill, which is not amortized or impaired, plus 2,88,000 that you can see here, you get 368,000. Alright. Then this 368,000 I will compare with what? I will compare that with the recoverable amount. The value in use is estimated to be 2,12,000. So what will I do? 3,68,000 minus 2,12,000. I get a loss of 1,56,000. Always remember, the first loss is allocated against goodwill. So goodwill becomes 0. and balance 76,000 is adjusted against other asset. Subsequently, give me a minute, I'll just charge the pencil. So first goodwill is 80,000 and 70, impairment is 80,000 for goodwill, and other asset it is 76,000, total impairment is 156. Then reversal of impairment loss. Now what happened? By 31st March of year 5, here we are talking about year 3, so 2 years have passed by. For 2 years you will calculate depreciation on 288 minus 76. 212. Carrying amount as on 31st March is 212. Accumulated depreciation for 2 years divided by 18 into 2. I think there is a mistake here, sorry. It should not be 24,000. 2,12,000 divided by 18 years of remaining useful life, right? 18 years of useful life into 2. So you have 23,555. 23,555 minus 2,12,000. It is 18445 is the 188,445 is the carrying amount. This carrying amount will compare with the value in use and recoverable amount higher of these two, so 304. We'll compare that with 304. Okay, so 188 and 304, whatever is higher, 304, 188, there is a reversal of impairment. Now here is where a lot of us get confused in the examination, or sometimes make mistakes in the examination as well. Whenever there is a reversal of impairment, I cannot directly say entire previously whatever is written off, entire amount can be reversed. No, that cannot be done. Entire 76,000 cannot be reversed. Okay, what you have to check, what is the carrying amount without impairment? 2,56,000 means original cost and depreciation for 4 years if I have considered, my carrying amount is 256. After reversal of impairment, my maximum amount can be 256 only. My maximum amount can be 256 only. So even though the recoverable amount is 304, I will restrict it to 256. So the thing that you have to keep in mind here is that maximum amount of reversal cannot exceed what? Original cost minus depreciation on original cost. So you will calculate one stream of carrying amount of asset separately, and the maximum amount of reversal you will ensure that maximum amount of not reversal, after reversal cannot exceed. So how much will be the maximum amount of reversal? Maximum reversal is equal to carrying amount minus carrying amount based on original cost. So maximum reversal can be only this. Okay, that is what you have to keep in mind. Make a separate note of this. Next, Alia Limited is a manufacturing company which deals in manufacturing of cold drinks and beverages. It has various plants. There is a machinery A in the Baroda plant which is used for the bottling purpose. There is one more machinery which is B clubbed with machinery A. Machinery A can individually have an output and be sold independently. Machine B cannot be sold in isolation, and without clubbing with machine A, it cannot produce output as well. What is the meaning of this? Machine A can generate cash flows. So I can test for impairment of machine A independently. Machine B cannot generate independent cash flows. So I cannot test machine B independently. The company considered this group of assets as a CGU, and an inventory amount to 2 lakhs and goodwill amounting to 1.5 lakhs is also included. Whenever these things are given, first what we need to do? First we will do the lowest unit possible. What is the lowest unit possible? Machine A. So first what we will do? We will take machine A. First we will take machine A, and for machine A we will calculate the impairment. So for machinery A, whatever has been purchased, on that we will calculate the recoverable amount and impairment. Then we will take machine A and machine B together, then inventory and goodwill, and calculate the impairment for the unit as a whole. Okay. So cash flows have been given. On 31st December, professional valuers have estimated that the current market value of machine A is 7 lakhs. The valuation fee was 1 lakh. Now, is this valuation fee related to my recoverable amount? No, it's an expense. There is a need to dismantle the machinery before delivering it to the buyer. Dismantling cost is 1.5. Yes, this is a cost to sell, so I will reduce that. Packaging cost will be 25,000, that also I will reduce, and legal fee 75,000, that also I will reduce. Inventory has been valued in accordance with Ind AS 2, and the recoverable value of the CGU is 10 lakhs as on 31st of March. So, recoverable value of CGU is 10 lakhs as on 31st of March. Inventories as per Ind AS 2. Will I again compute the loss on inventory? No, I will not do that. I will not again do it on inventory. In the next year, the company has done assessment of recoverability of the CGU and found that the value of the CGU is 11 lakhs. Recoverable value of machine is 450 and combined of A and B is 760 as on 31st March of 19. Such a long question. If you practice this type of questions, 1 or 2 questions, all the concepts that you need for impairment are done. Okay. So first, compute the impairment on CGU and carrying value of each asset. Compute the prospective depreciation. Compute the carrying value on 31st March of 19. So 2 dates are there. First, in this type of question, first thing is carrying amount of asset. Machine A separately, machine B separately. What is the carrying amount on 31st March? 525, 350. Okay. Then, recoverable amount of machine A. For machine B, we don't have recoverable amount. We have recoverable amount for machine A. We'll take the cash flows, including residual value, and figure out what is the value in use for machine A. That comes to 489,770. Okay. Just a moment. So value in use for the machinery is 489,770. Fair value less cost to disposal. The valuer has said 7 lakhs. Okay. The dismantling cost, the packing fees and the legal fees, total cost comes to 450. Total fair value less cost to dispose. Higher is 489. This will be considered. Now here, one thing that you have to understand is that this particular case, that there is a legal fee of 1 lakh that has been consultant fee of 1 lakh that has been incurred. This will not be considered. Okay. Then recoverable amount is 489. Recoverable amount 489, carrying amount 525, impairment loss is 3235230. Right. Then first we have done impairment on machine A. First, we have done impairment on machine A. So, always remember, whenever you have individual machines, CGU and all of that, you will start from the lowest level possible. So, when you start from the lowest level possible, first you take machine A, done the impairment. Okay, we got the impairment, and after that carrying amount is 489. Using this value unit. So, machine A 489,770, machine B 350. Where did we get this 350 from? Actual carrying amount. Inventory 2 lakhs, goodwill 1,50,000. This is what is given. What is the carrying amount of CGU? So much. A recoverable amount is given to be 10 lakhs. Difference is impairment loss. Simple. What will we do with this impairment loss? First, write off goodwill. Then, don't do carrying amount of A and B. Sir, why? Because always remember, if machine A has a higher recoverable amount, or if machine A is already shown at recoverable amount, I cannot charge further impairment loss, because machine A independently I can sell it off at 489,770, or I can get the value of 489,770. So whatever is the loss entirely will be borne by second machine. So carrying amount is 489 after impairment, machine B 310, inventory 2 lakhs, goodwill 0, total is 10 lakhs. Then subsequently what has happened? Subsequently recoverable amount of machine A is 450 and combined of machine A and B is 760 as on 31st March of 19. So after that, carrying amount we have calculated, residual value is 50,000, then depreciation you can calculate, you get the carrying amount of 4,01,000 and 2,65,000. Okay, then when we are reversing, 4,01,000 is machine A, 265 machine B, inventory 2 lakh assumed, goodwill is 0, total carrying amount is 867, recoverable amount is 11 lakhs, excess is how much? 232, 272, that is the excess. Now that excess, what we will do? We will have to reverse. How will we reverse? See, carrying amount without impairment is 4,30,000. Carrying amount after impairment is 4,01,000 here. The difference is 28,184. Maximum we can reverse 28,184. For machine B, carrying amount without impairment 3 lakhs. Carrying amount after impairment 265. Maximum reversal 34. So this will be the maximum amount that can be reversed for each of the machinery. If impairment loss reversal was lesser, means if there is only, let's say, 10,000, then in that case the reversal will happen in the ratio of the carrying amount. Okay, that is how we will do. Then the recoverable value of machine A is 450 individually, but I cannot reverse it by more than 430. So I will be restricting myself to 430. Okay. Then for combined A and B is 7, cannot be more than the existing, that is 401 and 265. It cannot exceed that particular value. This is one very good question which tests the. This question will help you understand the pro rata basis. Okay, whenever proportionate share in net asset method is used, then in that case what is to be done? A Limited acquires 80% of shares of subsidiary B Limited for 3,200,000. At the date of acquisition, B Limited identifiable net asset is 300,000. A elects to measure NCI at proportionate share of net identifiable asset. So goodwill comes to 800. This is what? 80% of goodwill. Now whenever I am testing for impairment, I am taking the recoverable amount fully. I am taking the recoverable amount fully for 100%. Whereas goodwill I am considering only 80%. So if I am considering goodwill only at 80%, I have to gross up. Gross up means what? I have to charge or create a notional goodwill of 200, because 80% goodwill is 800. What is full goodwill? 800 divided by 80%. This grossing up is required only when we are following proportionate share in net asset method. Okay. So once I have done the goodwill, carrying amount 2,700. At the end of the financial year, the carrying amount is 2,700 and goodwill I will consider 1,000. Goodwill I will consider 1,000. So total is 3,700. Recoverable amount is 2,000. So the difference is loss. Impairment loss is 1,700. Now, this 1,700 of loss has to be allocated to goodwill and other assets. It has to be allocated to goodwill and other assets. Means 1,700, goodwill 1,000, other assets 700. Now goodwill is 1000. I have recognized only 80% in the books. So I will write off only 80% in the books, that is 800. Whereas others, 700 I have recognized fully. 80% will be taken by parent and 20% hit will be taken by NCI. So 560 goes to parent and 140 goes to NCI. If the recoverable amount is 2800, if the recoverable amount is 2800, impairment loss is how much? 900. Entire impairment loss will be adjusted against goodwill. But 900 is the total share, total impairment. We have recognized only 80% of the impairment. So we will consider only 80% of the impairment, that is 720 in the books of accounts. You can do it on your own. So guys, I'm continuously coughing, so I don't think I'll be able to continue now. Sorry for that. I thought I'll be able to pull up the full day, but throat is not supporting. So we have completed till Ind AS 36, right? Remaining, I'll schedule a live or I'll record it, and mostly I'll do it live only. Okay, tomorrow and I will I'll plan it, and tomorrow I'll try to complete the remaining portion. I so much wanted to complete this, but continuously there is coughing happening, so I'm not able to focus fully on the session. Sorry for that, right? But definitely for the remaining standards also, not only these standards, the other standards also, definitely we'll be doing it tomorrow. I'll try to finish it off. If 1 or 2 standards are left, okay, that also I will ensure to provide it to you, as early as possible. And yes, what I will not be doing, I'll tell upfront itself, like Ind AS 37, largely theory standard, okay. Ind AS, let us say 8, Ind AS 10 and all of this, where only theory is to be discussed, that I'll not be doing. You can refer to my summary notes and revise it from that. But yes, wherever computations and all are involved, where mistakes can happen and all of that, I will, if I get better, maybe we'll send out a notification and I'll do another 2 hours today, and then balance I'll complete it tomorrow. Right now I'm not able to focus because of the interruption due to cough. Okay, thanks. Yeah, I'll upload the compilation PDF, and you'll also get the notification for that. Thanks everyone.